Hello, everyone. Hello. All right, we got an interesting topic here today. First of all, out of curiosity, who watched the debate last night? Anybody watch it? I watched it. Yeah, I think probably everybody in our on our team watched it. Um, but Joel, I want to put you on the spot here. Did you watch it last night, buddy?
I I did not. I saw clips as it was happening, so I got snippets.
Okay, awesome. Colin, did you watch it last night?
I did at least the first hour and change.
Yeah. Who you voting for? No, I'm
Yeah.
just kidding. Um, yeah, I thought it was pretty interesting. I won't comment too deeply on it, but I'm gonna watch it again later today, or tonight, and kind of slow it down and zoom in on certain topics. But I thought it was pretty interesting. I also think it's pretty interesting that we now have the option of long form podcasting. So I would strongly encourage anybody who's going to vote this year to actually go and watch some uh, non-mainstream media podcast interviews with these candidates because in my opinion, regardless of what side of the aisle you're on, it allows you to get 5 to 10x deeper on different topics rather than just going on ABC or CNN or wherever. It doesn't matter where you go, rather than the soundbite culture. But I don't know, Colin, I've watched probably like an hour to an hour and a half long interview with Trump and other candidates as well, not with Harris, because I don't know if she's done any. That's not a dig. As to my knowledge, I don't think she's done any long form, off label podcasting. But highly recommend for those of you who are interested to actually go and watch some podcast with your particular candidates, or actually all candidates. Colin, what's your perspective on that?
Yeah, I mean, and again, not to lean one way or the other, but I think RFK Jr. did us a solid in this regard because I think he was the first one to kind of take the plunge and put a bit of pressure on people to sit down in a more comprehensive manner and be able to articulate their views on certain topics or certain issues and not have a 2-minute timer be
Yep.
the limitation to it, right? So I think that's great. I think it's an interesting strategy by Trump. He is definitely going on some of like the younger generation podcasts. And that's a lot of the younger generation is tuned into some of these Twitch streams or some of these podcasts that he showed up on. So I would understand if those podcasts might not be your favorite, or your go-to if you're going to get the a more in-depth conversation. But I know Wes is a big fan of this podcast. I listen to it religiously. He went on a podcast called All In, and he was there for 45 minutes or an hour with some people in the tech industry and in high ranks of business that can really joust, and they did not throw him softballs. They've had multiple other political candidates on there as well. So I think that's an interesting place to start if you haven't seen that already.
Yeah, absolutely. And Joel, any place that you choose to get your information from for politics, just in case of people looking for more resources.
Uh, I think the long form podcasts are great. I think that's the real struggle with the debate format that we have. There's just not enough time for a candidate to actually explain their position and do it in an effective way that we can understand where they really stand on that issue. So I agree with you guys. Although I take offense to the fact that you think that us seasoned people on here would not listen to some of those podcasts. You are wrong, sir. So
Oh, no. No, absolutely. So I'm just saying for anybody who hasn't heard of these, I mean, whether it be All In podcast, there's a ton of them. I mean, literally, there's several comedians now who have interviewed Trump and a few of the other candidates, and they're on there for an hour plus,
I
and it's not scripted, and these people are not even media trained, which I think is a good thing. It's a different, like
Mhm.
almost like first principles way of approaching the topic. So they're asking all these important questions that are perhaps important to them and their demographic. So I think we're going through
That's
a really
awesome.
right now from an educational perspective.
I really agree with that, Wes, because you familiar. It's kind of an old system, the Sandler sales system.
Yep.
They've got a thing called the dummy effect, which sounds kind of derogatory, but what it actually is that people who are novices in a business ask
far better questions than the seasoned professionals who think they have it figured out, because the novices are actually trying to understand and get to the real answer. So I think it's really a positive for a non-political podcaster to ask questions that maybe like a softball network person would not throw out to the candidates and make them explain their position.
Right. What do you guys think about um, Elon Musk being invited to, let's say, a task force that has been proposed to clean up the government? I think it's really interesting. So are you guys familiar with that? And Colin, I'll throw you the ball first, and then what's your take on it?
Well, I'm at least conceptually in favor of it. I haven't I guess I don't understand enough about it at this point, but conceptually, I'm all on board. Um, I think I read, and please don't hold me to this. I think I read that we now employ more people in the government than we do in the private sector, and I think that that's a problem if true, right? You start to kill incentive, right, when the government is controlling too much. Now, don't get me wrong. I'm a big fan of regulation, and low hanging fruit there. We do not want an unregulated airplane industry, right? We certainly want a certain amount of regulation. But there was a big criticism of Elon when he bought Twitter and he cut 80% of the workforce. And they thought like, oh, no way that this will survive, right? They created the grave for Twitter, that he is now surpassed by, at least months, if not years at this point. And the app, at least from metric standpoint, seems to have more active users, more engagement, right? It's not, I use it from time to time. I don't experience like, technical hiccups, etc. So if he does conceptually the same thing, if he leads up a task force to thin the government out without consequences of, deregulating certain, important areas of government, and without stripping it, and we can remain competitive, and it does what it needs to do. I think that that's a great thing. And it gets people back into the private sector where the real innovation, where the real growth of this country stems from. So,
Right.
again, just to put a ribbon on that, I do not know enough about what the actual plan is there, but in concept, I think it makes a ton of sense.
Yeah, from my understanding, it's basically putting together a task force that's going to perform some sort of massive audit and say, okay, well, has the government swelled to a certain degree that is no longer as useful as maybe it once was? And I was listening to an interview with Elon Musk, and he was talking about this, and he gave some examples. He said, if you think about it, our next, and I think actually he just did a rocket launch when, like 2 days ago, maybe. Um, if you think about it, we were delayed in our rocket launch because of paperwork being delayed at the government. And he said, we built an entire rocket ship from scratch before they were able to commute the paper from one desk to the other to get it approved. Kind of wild if you think about it. Like, that's insane, right? We built an entire rocket ship from scratch, and that moved faster than the documents did at whatever governing body had to approve or not approve of the rocket launch. Pretty crazy to think about. He also mentioned that SpaceX was fined $140,000 for using water to cool. I know nothing about rocket ship building, obviously, but like putting water on the landing pad, right, to cool it down, essentially. Some sort of environmental agency fined them $140,000 because they did not have the permit to do that. And his response was, and his team was, well, water falls from the sky on a weekly basis here. Why are we being fined for just put? There was no harm. This was not tainted water. This was just straight water, just using. Apparently, they needed a permit to spray water on the ground. And their response was, sorry, we didn't realize we had to have permits for this. But these are the examples of things that are held up. Now, I'll use an example out here in California. I think it's was like the high speed rail. I think we've now, I think the numbers are like in the billions. I think it's like $7 billion, something crazy. I could be wrong about this number, but it's in the couple billions, I believe. $7 billion on building a high speed rail, and it's now been multiple years, and it's not built. It's like 1,600 miles of some like preliminary track, and the track's not even laid yet. So my personal point of view on this is if we look through certain dimensions, I think, but depending on how you measure it, now government employment or government payouts now are roughly tapping on 50% of the US GDP, which is an incredible footprint of government disbursement. My personal view is I start to get a little concerned about that. And I think Elon also had a really good point of saying we at some point, if you just keep on putting more rules, more rules, more rules, more rules down, then eventually everything becomes illegal, right? Taken to its natural extreme, you can't make progress. And America was built off of innovation and progress. Um, but while we have a system to lay down rules, we do not have a system to remove rules that are not effective. So you get this compounding, almost this evolutionary effect, but it doesn't subtract from the past iterations. So you get this very bloated, chunky system that does not allow for progress. Joel, what's your perspective on that topic? Do you agree with the task force if it were to actually be put in place? Because Elon is saying, hey, if we do take action, we're going to have to take pretty sizable action because you only have a 4-year window to unwind potentially decades worth of muck.
Right. Yeah. So it's great on a couple of levels, and I don't want to. I'm not picking sides here, but I think it was tremendous political move by Donald Trump because he was the one that enlisted Elon, because he reaches an entire demographic that probably Donald Trump is not that popular with. So as a gamesmanship move in the political arena, I think it was fantastic. As practically, I think Elon, if anybody could do it, he could do it. And we go back to Twitter as that example, but the maybe unintended consequence of that is then what do we do with like 5 million unemployed people now, right? Because we've eliminated their job in a government capacity. They have to go somewhere. Do we just end up with them being supported on government role somewhere? Because I don't, that's not efficient because now we're just moving them from one place to the other and the money's still being spent to support them, but they're not being productive at that point in time. So it's, I guess it's just not as easy. It's not as binary as it seems like, well, we reduce the size and scope of government, the country's better off, but we also put a massive amount of people out of a job. And then what do we do with them?
Yeah, it's a good topic to chat about. And again, we just want to put forth our honest opinion in the education,
Right.
and everybody can make their own decisions. So I forget what fallacy they call that, but let's, for the sake of this conversation, let's call it like job loss fallacy. So there have been many iterations of capitalism that have put us up against the same problem, right? And one that comes to mind is kind of a weird example. When barbed wire was created, it essentially put all of the cowboys out of business because barbed wire was an innovation that reduced the cost of fencing by about 95 to 99%. So now you didn't have to have like picket fences, right? And wooden fences. You could just put barbed wire, and it would therefore keep the cattle in a certain geographical region. So therefore, you didn't need as many cowboys. So you essentially, if you were a cowboy, that's why the cowboy apparently era lasted a very short period of time, was because of the innovation, from my understanding, of barbed wire. Um, well, on paper, yes, you now have all of these displaced cowboys that could no longer find a job. Well, then if we fast forward, then why is our unemployment basically at record lows? And I could argue all day long about like the unemployment number and how it's people actually looking for a job who are in that category versus not looking for a job. So what has to give? And if anybody has the time, read the book called The Rational Optimist. And the reality is that human innovation is forever ongoing and historically has been because human desire is infinite. So as soon as you bring to a solution to the table, you now as a human have a need for more, for more, if that makes sense. So in other words, if anybody's ever gotten into the horrible sport, which is quite lovely in my opinion, but it's like horribly distracting, called bowling. So I had a friend beat me at bowling, and 3 years ago, and I've thought about it probably once every other week since then. So I went out, so I now have a need to beat him. So I went out and I bought my own ball, I bought my own shoes, and then and then you learn that you have to, like, polish the ball with this, like, cream and, like, this microfiber towel and so on. So it just opens up a whole can of worms in terms of needs. And I think the same level of logic applies to employment. So what Elon would say, and he did say at this conference, was all you have to do is you look at a macro level, look at countries, and look at North Korea and South Korea. Look at communistic countries, and they have a neighboring country or perimeter where people could flow into a capitalistic society, or at least a partial capitalistic society. You generally have a one-way road over towards the capitalistic society. In other words, you don't have to fight people off from leaving America going into Cuba. Right. That's not the directional flow that you have to solve for. You have to solve for the directional flow of people coming illegally into America. I'm not making a moral statement here, right? But if you just look at the flow, you have very few people knocking down fences to get into a communistic company or organization. So what Elon's premise is that essentially, if you look at government, it's almost more of like a communistic or socialistic type of entity, versus when you free when in his opinion, when you free these people of those occupations, they will disperse into the the capitalistic environment, and therefore find a better job, and therefore be more prosperous at the family level. So, Colin, what's your perspective on that? Like, if Elon were to do this and do this audit at a mass scale, and lay off in with judgment and empathy and intentionality, do you think these people would forever be lost with jobs, or do you think they'd find another outlet?
I think history speaks for itself there, and you kind of articulated it, like horse and buggy makers, or even way more recently, right? People making MP3 players or the Walkman, right? Where'd all those people go, right? Um, it's funny how narratives change. It wasn't, but I don't know, maybe 2 years ago or so, where all of our business owner clients were calling me up saying, "I can't find anyone to work."
Yep.
Right?
Mm.
And now, we wanna have that discussion of, "Hey, all these people will be out of a job," right? These things are so cyclical, and can get swept up in narratives that have divorced themselves from reality. And I think oftentimes that's what we see. It it is a bit of a nuanced thought, like, "Hey, how are we going to get rid of," I think my dad said 5 million jobs, right? That's a great number to start with. And then how are those people are going to provide for themselves or their family, if that gets eliminated over time? Typically it doesn't happen overnight. Typically it comes with a bit of a warning, right? And again, there's industry after industry that proves that they will be repositioned or reallocated to other sectors that are growing, that are expanding, right? And that's what technology has really given us. I just want to clear one thing up. I said employment earlier, that the government accounts for more employment than the private sector. I meant GDP, and Wes corrected me a few minutes ago. So I was wrong. I just wanted to get that cleared while we're still having this discussion.
We're gonna take a clip of that, you saying you're wrong,
Yeah,
and put
yeah.
so
The bloopers of the week, bloopers of
Yeah.
the Roundtable
I
bloopers.
I agree with both of you guys that it would get eaten, but the problem is there's gonna be some short-term pain, and it's not a problem, it's just the reality of it. There will be some short-term pain, and maybe Elon and Donald Trump, not an endorsement, maybe they're the ones to fix this, because they're not looking to get reelected, because no politician can create that short-term pain and continue to get reelected, because it's gonna take a while to play out. So maybe they're actually the ones that get this done. Now, whether they get elected, whether they can actually pull it off and do it, I don't know. But I think when you're talking about election cycles and people wanting to stay in power and stay elected because it's a pretty good gig, they make short-term decisions at the expense of better long-term decisions.
yeah, I think I think it's really interesting to think about, and there have been a bunch of experiments that have been done about this, but it seems like, especially at the government level, anytime you have a massive sort of one size fits all protocol for a critical mass of humans, the protocol tends to not work out. Like if you look at the pension system, there are very few people anymore who have pensions. Why? In my opinion, because you're trying to, if it's a one size fits all approach, how on earth could it be custom for you, Joel, or for you, Colin, and the needs of your specific family? And then you get this management to the lowest common denominator, which is why if you look at like the Social Security Department, I believe their returns of their investment accounts as of a couple years ago, I think was like 2.4%, something crazy. Well, how on earth, if you have inflation at, what is reported CPI 3-4%, how on earth could you keep pace if you have an investment return of 2.4%? By definition, you can't. But I think that's a result of there's somebody who's managing that, or a group of people who are managing that, and they want to play more defense than they do offense because they don't want to be the person that loses the money for the Social Security system. Same thing happens with pension systems. So I don't know. I think these things tend to get way over bloated and cannot be custom fit enough for families. So I think unfortunately what that means is families need to take more responsibility for their own destiny. But I actually think if you're a leader, I think that's a good thing, because then you can allocate the resources for your family and you on how you see fit rather than how some other person sees fit and doesn't even know you.
That's great. Because though you read my mind, let's take it down to a personal level to everybody on this call today, because that's what we're really concerned with overall. How does that affect us? If that were to happen, or if it doesn't happen, how do you think that affects us individually as we plan for our financial futures? And what actions can we take in order to protect ourselves or insulate ourselves from that?
Yeah, it's a great question. I think number one is the awakening to that problem, right? Like understanding that the responsibility actually does end up in your lap rather than not thinking about it. And I know that sounds so casual to say, but I think actually that's the common practice is people are saying, oh, the system will take care of me. It's like, well, let's define the system. Let's define what do you mean by take care of you? And I think any of us on this phone call actually know what the system actually produces and that you, in fact, can produce better results for your family, at least in my opinion. Colin, what's your opinion?
Yeah, I fully agree, right? With the outsourcing or the going away of pension systems, it inserts the now emotional roller coaster that you have to go on. So that's why we're always looking at our IRAs or 401ks going up and down. But we get to be far more strategic about how those dollars solve our financial goals or our financial needs. So the trade-off is, yes, you have to be able to manage your behavior and your emotions. But with some schooling, with some teaching, the benefit can now be that we are no longer trusting someone else with this, and that financial leadership actually is a positive impact to your family, not a negative one.
Yep, completely agree. All right, let's if you guys are cool, let's switch topics here. I want to show you. Let me see if I can pull this off. Um, when it comes to, I want to talk about risk versus volatility. Warren Buffett has commented on this. I've got a video to show you guys, but I'm noticing this as a very big theme in investor behavior, and that is really properly defining what risk is versus what volatility is. And the best way that I could probably summarize it is volatility is turbulence in an airplane. Risk is the airplane going down in a bad way, like you not landing in the destination that you intended. That these are two separate things. Volatility is a shakiness. The risk is like the chance of you not getting to where you want to go, right? A crash actually happening. And I think that what happens in society is when we're at the water cooler or we're at dinner with our friends and family, they will interchange these terms and it starts to really muddy the water. And they don't even know they're doing it. But this can perpetuate the linguistics we use not only in dialogue but in monologue in our head, and then therefore, right, our thoughts will become our feelings become our actions, blah blah blah, etc. So I think to have a recalibration conversation on risk versus volatility, And to illustrate this point, I want to bring in this little known investor named Warren Buffett, and he talked about this. Can you guys see this?
Yes.
All right. Colin, can you let me know if you can hear this? Give me 1 second. Let me fast forward to so this was Warren Buffett at a shareholder meeting. All right, Colin, give me the thumbs up if you can hear it, bud.
Ability to not measure risk.
All right, cool. So let me wind this
Could you
back.
guys expecting the Buffett?
So Warren Buffett and his recently deceased partner every year would do an annual shareholder meeting. Thousands of people show up to this thing, and it's amazing. I'm going to try my best to go next year. But anyway, he answers live questions. So this particular person was asking him about the topic of risk, and here's Warren Buffett's answer.
Volatility of a portfolio manager's results in the attempt to measure risk. So could you guys expand on your thoughts on this?
It's volatility to not measure risk. And the problem is that the people who have written and taught about volatility do not know how to measure, or taught about risk, do not know how to measure risk. And the nice thing about data, which is a measure of volatility, is that it's nice and mathematical and wrong. And in terms of measuring risk, it's a measure of volatility, but past volatility does not determine the risk of investing. I mean, actually, take it with farmland here in 1980 or in the early 1980s, farms that sold for $2,000 an acre went to $600 an acre. I bought one of them when the banking and farm crash took place, and the beta of farms shot way up. And according to standard economic theory, market theory, I was buying a much more risky asset at $600 an acre than the same farm was at $2,000 an acre. Now, people, because farmland doesn't trade often and prices don't get recorded, they would regard that as nonsense, that my purchase at $600 an acre of the same farm that sold for $2,000 an acre a few years ago was riskier. But in stocks, because the prices jiggle around every minute, and because it lets the people who teach finance use the mathematics they've learned, they have, in effect, they would explain this away a little more technically, but they have in effect, translated volatility into all kinds of past volatility in terms of all kinds of measures of risk. And then it's nonsense. Risk comes from the nature of certain kinds of businesses. It can be risky to be in some businesses just by the simple economics of the type of business you're in. And it comes from not knowing what you're doing. And, that it is, if you understand the economics of the business in which you are engaged, and you know the people with whom you're doing business, and you know the price you pay and is sensible, you don't run any real risk. And I don't think Charlie and I, certainly at Berkshire, I don't think we've ever had a permanent loss in marketable securities that was, 1% maybe, 0.5%. And that was made a terrible mistake in buying Dexter Shoe, which cost us a significantly more than 1% of net worth.
Anyway, I think that gets the point across. Let me pass the mic over to Colin. Colin, what's your perspective on that clip of Warren Buffett?
Yeah, brilliant as usual. I love how he breaks it down, right? It's such a good reminder as to what we're actually investing in, right? I love his terminology. You are not investing in a green or red line that jiggles minute to minute, right? You are investing in a business or a real estate property or a farm or storage units or some sort of value transaction, right? Where the business is able to sell something at margin and capture some of that for themselves so that they can, feed their families, reinvest in the business, continue to grow it into the future, right? That is why we try to reiterate all the time with everyone on this call and all the families and business owners that we serve. that you are not investing in the stock market. You are investing in a portfolio of companies, right? And yes, to diversify some of that risk, we don't put all of the money in General Electric or Enron, right? Because of the stories of those two. But when you own Costco and Home Depot and Microsoft and countless other fantastic actual businesses, right? Not the stock market, you are investing in value creation. And when they do that at scale and they continue to do this in the future, that is the rational justification as to why your portfolio appreciates in value over time. Again, it is not just a squiggly line going up. It is because Costco is more valuable today than it was 5 years ago or 10 years ago or however far you want to go back. He just does a great job of separating. And real quick, last thing I'll say on this, volatility is what we hope for. We just like it much better when it goes up instead of down, right? So volatility is just the deviation from what the cost that you bought it at was, right? Risk is like Wes mentioned. I thought it was a great analogy. Risk is the plane crashing and losing a permanent loss of capital, right? So we actually need volatility. If you don't have volatility, it's because you have a checking account, and that's your units of currency staying flat the entire time.
Yeah, but to add to that, and this is a common misperception as well, um, you don't have a choice. It doesn't matter what unit of currency or asset you peg, uh, it by definition will move from that destination. So if you go put $1 million in cash, it might look the same on your statement, but 5 years from now, it is not worth the same $1 million. Right. So it's kind of like rollerblading. What do they say? There's no maintenance mode. You're either speeding up or you're slowing down. There is no asset out there that doesn't move up and down in price. Now, whether or not it's recorded on a minute by minute basis is different, and that's what can really, sort of like trigger the pain. I thought it's pretty interesting. So the concept at a high level probably makes a lot of sense to people. But when we get into, okay, well, what's the degree? Right. What's the level of specificity? So I looked up some charts because, as you all know, I love charts. To really nail this home. So I personally thought this was fascinating. So if you look at the S&P 500, and you look at it over since the early 80s, you can see here returns right in the gray bar charts. But then what you also see is so this is the annual return, but then you get to see in the red marks the intra-year drops, which is really fascinating. So how a lot of returns are pegged is like, okay, January 1 to January 31st, right? I'm sorry, to December 31st. So you get the entire year. Well, there's turbulence in and throughout that year. So this chart shows, hey, you could have, let's just say I pick on, I don't know, let's say I pick on this year right here, where it's a 23% return, right? That's what you would see on your statement if you looked at the end of the year. But during that year, the account value would have gone down from peak to trough by 28%. And oftentimes that journey is lost in the numbers. So rather than hide from that, let's educate ourselves on what the actual path feels like. And it's so funny because I'm reminded of a story. Dave's family came out. This was years ago, and I was over at Dave's house, and his cousins from like the boondocks of Pennsylvania, like 4 hours deep, right into Pennsylvania, outside of the city, and they were describing. It's the first plane trip they ever took, and they were probably, the cousins were probably in their mid-50s. To hear a grown man describe what his first plane trip was like deep into his 50s is just fascinating because it's so interesting. We don't think about it. He's like, I thought the plane was going to explode. He's like, I had to take anxiety medication. I do because right, even when the plane lands, oh my gosh, it's supposed to land like that. When you take off, you're supposed to feel like your stomach's dropping and so on. But that's normal to people who've flown since the time they were a child. So if we actually educate ourselves about the process and then we experience it like all of you have on here with your actual money, then you start it never gets super comfortable, but you start to get more comfortable with the process because you know it's part of the norm. So anyway, there's also a risk in just defining averages, right? So I think that can kind of set somebody up for a little bit of shock as well. Oh, well, hey, I heard that the market or certain types of investments were supposed to give me 10% average annual return. Well, the key word there is average, meaning that when you talk in averages, it smooths out, right, the narrative, when the reality is it's choppy. So it'd be like, okay, if I put one hand, I had a buddy tell me this recently. If I put one hand in boiling hot water and the other hand in ice cold water, the average would be pretty nice, despite the fact that I'd have to go to the hospital, right? So talking about averages oftentimes can skew the conversation, but that chart that we just showed you kind of gives a little bit more live understanding of it. Colin, what's your take?
That's a great point because I think when you have that averages conversation, really good for large financial institutions that have a basically an infinite time horizon, right? But if you are approaching or in retirement and you are drawing from your investment accounts, well, now those averages are almost washed away and I don't want to say useless, but can certainly be misleading when it comes to how it impacts your life, right? We go back to the extreme example that Wes was talking about, it looked like it was 2010 or 2011. You would have said that, hey, the stock market was up 23% this year, but at one point in time, it was down 28%. So if you needed your $5,000 a month, well, you are pulling it out certainly over periods of courses or months of that calendar year when the stock market was significantly lower than 23%, right? And that absolutely affects your account balance, that you started at January 1 with and you end up with at December 31st. So that can be a very misleading, certainly while you're working and you're not touching you're in the accumulation phase. Yeah, you could say, "Oh, hey, I can let it recover," or it should average out to be 9% over the course of my working years. Maybe that's true, right? Maybe it plays out that way for you. But it's a different beast when you flip that switch and you go from being a contributor to those investment accounts to now being a taker, right? Those intra-year drawdowns, and I know that's a little bit of a nerdy term, right? But those intra-year swings or volatile moments in the stock market significantly impact your cash flows or the way that you're pulling your cash flow out of those retirement accounts. And that's why we can't just have this kind of gloss over one size fits all investment advice that our industry loves to spit out at people. Like, oh, just let it go and it'll be 9%. That's dangerous when you start to kind of drill down into some of the nuances of that.
100%. I think the pragmatic view, that I personally I try my best to take the pragmatic view is defining risk for myself and for my family of like the probability that I'm not able to pay my bills. Right? So this is where this is why we're such sticklers on cash flow based assets, productive assets versus speculative assets, because and some of you have seen this chart 100 times, but it's probably my favorite chart. If we look at a market line and then we cross-pollinate a market line with a dividend chart, I want to see this type of behavior. That okay, even during market volatility, that if these investments are paying out cash flows and I use those cash flows to pay my bills, then the volatility, therefore, I'm shielded from. Right, but we gotta be careful again when our friends and family say, "Oh, well, hey, the stock market's risky." It's like, "Hey, can you do me a favor? Can you define what that means? What's the yield on your investment? What kind of cash flow? Do you have productive assets or speculative assets?" Right? Do you have 2 to 5 years left in cash and cash equivalents so that it can shield you from any recessions? I guarantee you by that time, the person has already left the dinner because you've asked too annoying of questions, right? But the problem is if we don't dig deeper, then we leave ourselves in this sort of like mental and emotional purgatory. And to really drive this point home, final thoughts here. Colin sent me this great chart recently, and this was from I think the source was Dividend Growth Investor on was it Twitter? Was it that's where you got it from, Colin?
Yep. Yep.
And I'll just read it to you guys here. I thought it was really interesting. It said someone who retired with $1 million at the end of 1999 in the S&P using the 4% rule would have $330,000 by the end of 2023. Alternatively, someone who retired with $1 million at the end of 1999 in Dividend Aristocrats using the 4% rule, so again, dividends being crucial there, using the 4% rule, would have over $5.25 million at the end of 2023. Now, I don't want to get hung up on, we're not recommending anything here, but just to draw the point, right? The importance of cash flows. I can't stress that enough. Every single presentation, every single class that we teach talks about this specifically for your long-term assets, not for your short-term assets, but for your long-term asset bucket. Very, very important. And that being a critical factor in reducing the risk that you and your family can take care of the bills. Colin, final words of wisdom, buddy.
Yeah, I think that chart was great because it highlights, well, again, one of those generic general rules of thumbs, like, oh, hey, you can withdraw 4% of your account and never outlive your money. Yeah, yeah. There's study after study where, there's what's called the nerdy terminology, sequence of return risk of, hey, that is exactly why, right? Just putting all your money in one account, drawing 4% off of it and thinking you can never outlive that, never not outlive that money is a dangerous piece of advice that our industry is oftentimes too lazy to update some of that thinking. So I think that was a great visual for people. And by the way, that was over 20, not without turbulence, not without volatility. That was over 25 years of some of the best market returns we've ever seen, right? So if it doesn't happen in some of the rosiest times, at least, on the whole, if it's not as good or better moving forward, then that strategy only gets more detrimental and more painfully impactful for the families that we're working with.
Yep, absolutely. There was a great comment from the head of Ogilvy Advertising in the UK, I believe, and the guy's name escapes me. But he wrote a book and it was outstanding. I'll have to think of the book and send the name out to you guys. But they talked about oftentimes 1 times 100 versus 10 times 10 are very different things, even though they come to the same answer, right? So in other words, right, it has to be custom fit. Just because you get to the same conclusion does not mean you take the same path to get there. So for finance and for a family's finances, it absolutely must be custom fit, in my personal opinion. Anyway, I love you guys. Thank you so much for taking the time. If anybody has any questions, either shoot it in the chat or shoot us an email or give us a call, forever and always. And if this sparked any good topics that you guys want us to talk about in the future, please let us know. And it was great seeing all of you. Thanks, guys.
Yep. Appreciate you all. Thank you.